Most people believe markets react to news. A headline appears. Prices move. Bad news pushes prices down. Good news pushes them up. That explanation feels logical, and it's also incomplete. Markets don't fear bad news. They fear what most people haven't noticed yet. By the time a headline reaches your screen, it's already old information. Institutions, algorithms, and large capital have already adjusted. What you're reacting to emotionally is often something the market processed quietly hours, days, or even weeks earlier. This is why markets can fall on good news and rise on bad news. It's not because the news is wrong, it's because expectations have already shifted. Right now, gold and silver are doing something that confuses a lot of investors. The price action feels unstable. Sharp moves happen quickly. Confidence disappears just as fast as it appears. But confusion usually shows up after something important has already changed, not before. The goal today is not to predict a headline or chase a breakout. It's to understand what the market is signaling beneath the surface. Because when price stops behaving the way people expect, that's not chaos, that's information. And if you learn how to read it calmly, without fear, without urgency, you put yourself on the right side of probability. Let's start by grounding ourselves in what actually happened. Over the most recent trading sessions, gold and silver experienced heightened volatility, marked by sharp intraday swings and rapid reversals. Starting with silver, price action showed a clear shift from a strong upward move into a consolidation phase. After reaching recent highs, silver printed a large bearish reversal candle, followed by a period of back-and-forth trading. Since that reversal, price has remained confined within a defined range rather than establishing a new trend. On the downside, multiple tests occurred in the 70 to 71 US dollars per ounce area. During these tests, price briefly dipped below this zone intraday, but consistently closed with candle bodies holding above it, indicating repeated defense of that level. On the upside, advances stalled in the 92 to 93 USD range, where several attempts to push higher failed to hold on a closing basis. As a result, silver has been trading between these two boundaries. During this period, silver also experienced single-day moves exceeding 10%, reflecting elevated short-term volatility compared to earlier weeks. Despite the size of these moves, price remained inside the broader range, with no confirmed breakout or breakdown. In gold, price behavior has been comparatively steadier. Gold pulled back into the 4,300 to 4,400 USD area, where prior highs and lows overlap on the chart. This zone has acted as a technical floor during recent sessions, with price stabilizing rather than accelerating lower. On the upside, gold encountered resistance near 5,100 to 5,125 US dollars, a zone defined by recent pivot highs and prior consolidation. Price approached this level but did not sustain closes above it. Compared to the previous week and month, both metals transitioned from directional moves into range-based trading. Volatility increased, particularly in silver. Neither market has confirmed a new high or a decisive breakdown. At this stage, the observable facts are limited to where price has moved, how fast it moved, and where it paused. No conclusions are drawn yet about what comes next. With the factual groundwork established, the next step is to examine why this type of price behavior matters beyond today's charts. Price movement by itself is information, but how price moves and where it fails to move often matters more than the size of the move. In both gold and silver, the recent behavior shows a shift from momentum to hesitation. Markets that were previously trending are now spending time moving sideways within clearly defined zones. This transition is important because it reflects a change in decision-making across different market participants. The first-order effect is straightforward. After a strong advance, prices stopped making consistent higher highs. Instead, rallies stalled at known resistance levels, while pullbacks found buyers at previously established support. This tells us that neither side, buyers nor sellers, has been able to assert full control. The second-order effect is more subtle and more important. When price fails to extend higher after a strong move, expectations begin to adjust. Participants who entered late in the trend often expect quick continuation. When that continuation doesn't arrive, their confidence weakens. At the same time, participants who missed the earlier move begin to wait for lower prices rather than chase strength. This creates a psychological imbalance, not because something bad has happened, but because certainty has been removed. In silver, this process is more visible due to higher volatility. Large daily swings inside a range increase emotional reactions, even though the broader structure remains unchanged. This tends to impact short-term traders first, as leverage and shorter time horizons are more sensitive to rapid price changes. Gold, by contrast, reflects a different chain reaction. Its relatively steadier behavior suggests a larger proportion of positioning tied to longer-term capital. However, even in gold, repeated failure to push beyond resistance shifts attention away from upside momentum and toward downside risk management. Another layer of cause and effect comes from market positioning. When prices consolidate after a sharp move, it often coincides with reduced aggressive buying, gradual unwinding of short-term leverage, increased selectivity in new positions. This process does not require panic or forced selling to have an impact. It simply requires time. As consolidation extends, the balance between buyers and sellers becomes more sensitive to incremental changes in liquidity, yields, or currency movements. Importantly, none of this depends on headlines. These dynamics unfold quietly through positioning and behavior rather than news events. The key takeaway is that markets often signal risk before it appears obvious. Sideways price action after volatility is not neutral noise. It is a period where expectations reset and probabilities begin to shift. Understanding this cause and effect relationship allows investors to step back from day-to-day price swings and focus instead on structure, behavior, and positioning. With that framework in place, the next step is to put the current environment into perspective by looking at historical periods that were similar, but not identical, to what we're seeing now. Periods of consolidation following sharp price movements are not unusual in gold and silver markets. Looking back at prior cycles helps provide context, not forecasts. Historically, both metals have shown a pattern where strong advances are followed by multi-week or multi-month ranges before a clearer directional move resumes. These pauses often occurred after momentum-driven phases, when positioning became crowded and expectations were heavily skewed toward continuation. One comparable environment appeared during past precious metals rallies where prices surged quickly, drew significant attention, and then stalled near well-defined technical levels. In those instances, markets did not immediately reverse or continue. Instead, they spent time rotating within a range as participation shifted from momentum-driven buyers to more selective, longer-term participants. What mattered in those periods was not the eventual outcome, but what happened before it. Volatility increased after the initial move. Directional conviction weakened. Price began respecting prior support and resistance more precisely. In several historical cases, this phase served as a filter. Weaker hands were gradually removed, while stronger hands waited for clearer signals. Importantly, this process unfolded without dramatic headlines or sudden macro shocks. There are also meaningful differences today. Market structure has evolved. Algorithmic trading, faster information flow, and increased access to leverage have compressed timeframes. Moves that once took months can now unfold in weeks or even days. As a result, consolidation phases may appear shorter but more volatile. Additionally, the current environment includes greater cross-market interaction. Precious metals are now more closely watched in relation to currencies, interest rates, and broader risk assets than in earlier decades. This means price behavior may respond more quickly to shifts in those variables, even if the underlying structure appears similar. Another key distinction is scale. Absolute price levels today are higher than in many historical comparisons, which affects position sizing, margin sensitivity, and psychological thresholds. The purpose of reviewing history here is not to suggest repetition, it is to reduce emotional bias. When investors recognize that consolidation and volatility have occurred many times before, often without immediate resolution, it becomes easier to avoid overreacting to short-term price movement. History reminds us that markets often spend more time transitioning than trending. Recognizing that transition phase for what it is helps keep decision-making grounded in process rather than emotion. With perspective established, we can now evaluate forward-looking possibilities using probabilistic thinking rather than predictions. At this point, the goal is not to forecast a single outcome, but to map reasonable paths based on how markets typically behave under similar structural conditions. Each scenario depends on what changes, or fails to change, from here. Bull case, strength reasserts itself. In this scenario, price must do work, not simply react. For silver, this would require sustained closes above the upper boundary of the recent range, Acceptance above prior resistance, not just intraday spikes. Reduced volatility on pullbacks, suggesting stronger hands in control. For gold, the bull case requires a clean break and hold above recent resistance. Follow through that attracts incremental capital, not short covering. Stability rather than acceleration after the breakout. If these conditions develop, it would suggest that the consolidation phase served as a reset rather than a reversal, allowing the prior trend to resume. Importantly, this outcome does not require optimism or bullish narratives. It would be driven by price behavior confirming demand, not expectations. Base case, range persists, volatility gradually resolves. The base case assumes that current conditions largely remain intact. In this environment, prices continue to oscillate within established support and resistance. Breakout attempts fail to sustain. Pullbacks find buyers at known technical levels. This is often the most common outcome following sharp moves. Markets digest gains, participants reassess risk, and time replaces momentum as the primary factor. Under this scenario, short-term traders remain active. Longer-term participants stay patient. Directional conviction remains limited. The significance of the base case is not excitement, but discipline. Range-bound conditions reward selectivity and punish impatience. They also tend to frustrate both bulls and bears, which is why they often last longer than expected. Bear case, structure breaks, risk reprices. The bear case becomes relevant only if key supports fail decisively. This would involve breaks below established support levels, follow-through selling rather than immediate recovery, increasing downside momentum paired with expanding volume. If this occurs, it would indicate that the consolidation phase resolved through repricing rather than continuation. In practical terms, this reflects a shift where buyers step back and sellers gain control, not through panic, but through persistence. This scenario does not imply long-term weakness in precious metals. Historically, such moves have often represented repositioning phases, where price seeks levels that attract stronger, longer duration demand. Risk perspective. None of these scenarios exist in isolation. Markets transition between them as conditions evolve. The professional approach is not to commit emotionally to one outcome, but to adjust exposure as probabilities change. Probabilistic thinking accepts uncertainty as a feature, not a flaw. It focuses on what price is doing, not what it should do. With scenarios defined, the final step is to clarify what indicators matter most in determining which path is gaining traction. Rather than focusing on headlines or short-term commentary, I rely on a small set of indicators that consistently influence precious metals over time. These inputs help determine which scenario is becoming more likely without requiring prediction. One of the primary factors is the US dollar index DXY. Historically, periods of sustained dollar strength tend to coincide with headwinds for gold and silver, while periods of dollar stabilization or weakness often reduce that pressure. The focus is not on day-to-day fluctuations, but on whether the dollar is trending or stalling near key levels. Another important input is Treasury yields, particularly on the longer end of the curve. Rising real yields increase the opportunity cost of holding non-yielding assets like gold and silver. Conversely, when yields stabilize or decline, that relative pressure eases. I pay close attention to rate of change, not just absolute levels. Inflation data, including CPI and PCE, also plays a role, not as a headline event, but as a contributor to expectations. Markets respond more to how inflation data compares to expectations than to the raw numbers themselves. A consistent pattern of surprises in either direction can gradually influence positioning in metals. From a market mechanics standpoint, volume and liquidity are essential. Breakouts or breakdowns that occur on declining volume tend to lack durability. I want to see whether participation expands or contracts as price approaches key levels. In silver specifically, open interest and positioning offer additional insight. Sharp increases in open interest during consolidations can signal rising leverage, which often precedes volatility. Decreases, on the other hand, may indicate that excess positioning is being reduced. Finally, I watch how price behaves after data releases rather than during them. The initial reaction is often noise. The follow-through, or lack of it, provides clearer information about underlying conviction. Together, these indicators help filter out distraction and keep the focus on process rather than prediction. They don't tell me what will happen. They help me understand what the market is responding to and when risk may be shifting. With that framework in place, the final step is to step back and close with a disciplined, long-term perspective. At moments like this, the most important skill is not prediction, it's restraint. Markets move through phases of momentum, transition, and rebalancing. What we're seeing now in gold and silver fits within that broader rhythm. Volatility and consolidation don't demand action by default. They demand clarity and patience. This is where risk management matters more than conviction. Knowing your levels, understanding your time horizon, and accepting uncertainty are what allow you to stay objective when price action becomes uncomfortable. There is no urgency to be right today. There is value in being prepared tomorrow. Long-term opportunities are built by respecting probability, not by reacting to noise. And short-term uncertainty does not invalidate long-term structure. It simply reminds us that markets don't move in straight lines. This isn't investment advice. It's simply how I'm reading the market right now. Stay disciplined, stay patient, and let the market do the hard work for you.